To explain franking credits and how they affect taxation. So this is Dave. Dave owns a business in Australia, Dave's Donuts. He's a 100% shareholder of this business, so it is owned wholly by Dave. This is the tax office. Their job is to collect tax on profits and income and then distribute it to pay for essential services. Keep in mind the tax office pays for this from many other sources. A big bag of all collective taxes, if you will. This bag won't be required to explain how franking credits work, but it could come up again later. Dave runs his business and Dave's Donuts turns a profit of $20. This is what is left of the money that has passed through his business after he's paid costs or expenses, such as donut dough. Dave's Donuts and Dave are not the same person. The company is a separate legal entity. The tax office also wants a fair and reasonable portion of this profit to pay for services. Dave can pay himself a wage, and this wage will impact on Dave's Donuts. For the purpose of showing this relationship, we'll assume Dave's personal rate is 30%. In reality, this could be higher or lower. Because Dave is a person and shareholder of Dave's Donuts, he can decide how this profit is allocated. He could leave it all in the business and pay $6 company tax and no personal tax. He could split it and pay $3 company tax and $3 personal tax. Or, as he has personal bills to pay and Dave's Donuts can't pay them, he could decide to withdraw it all and pay $0 company tax, $6 personal tax. Dave's effective personal tax rate will be a different number depending on his total income, and will most likely be different to the company. But you can see that lowering one tax debt of the company or individual will increase the other for Dave, because he is the owner of the business. Dave's personal effective tax rate won't be the same as his company. It could be higher or lower. This creates a taxation problem where people might not always be taxed the same amount for the same profit or income. In response, government has decided that where profits are distributed to shareholders, they should always pay tax via the same method. This stops the rich from using the company to pay a lower tax rate and avoid paying their fair share of personal tax. The government has selected this to be the personal rate of tax, which is the fairest way to do it. You will often hear this described as avoiding double taxation, but a better way to describe it might be to say a single method of taxation. Now that we've established that it should be assessed as personal tax if passed on to the individual, we can now find whether someone's distribution from their company is taxed fairly by testing whether the tax is assessed and paid the same as if it was paid as a wage. Dave can distribute his company's income to himself in a few different ways. One is as a wage. Dave pays this from the company before it pays tax. A second is an unfranked dividend. This is a distribution from profits to shareholders before tax has been paid or without franking credits. A third way is via a franked dividend. A franked dividend would be paid if company tax had been paid first. The dividend is then passed on to the shareholder. The first thing you'll notice is Dave has less money than if a wage or unfranked dividend was paid, regardless of his other income or tax rate. Let's tax Dave now. For this example, his effective tax rate is 35%, higher than his company. The number won't change the outcome. Firstly, I'll give a common example of how Dave's profit is not taxed. Many will assume that Dave is taxed 35% on his $14 franked dividend. This means he owes $4.90 in tax. If he adds that to the company tax, the total tax pool paid on his profit of $20, $10.90, more than half of what he made. So that's obviously not right, but the problem here actually has nothing to do with double taxation. To show you the problem, we can apply the wage test and ask, how would Dave be taxed if he was paid a wage? So if Dave was paid the same wage and his personal tax rate was 35%, he would owe $7 tax, not $4.90. I like Dave, but let's not let him avoid paying his fair share of tax. So this already doesn't pass the wage test. It is not only the tax due which doesn't pass the test, but also his taxable income, which would be $20, not $14. And that is where franking credits come in. When a franked dividend is paid, first a company must have already paid tax. The dividend is transferred to the shareholder. This comes with credit attached for no more than the portion of tax the company has already paid. The credit for this tax is imputed to the shareholder. This means the shareholder is now responsible for this tax, even though no physical transfer has occurred. It remains at the tax office. It is used to credit the tax paid and also added to his taxable income, or to be more direct, Dave pays tax on this tax credit. You might notice this in the real world if you ever receive a franked dividend for a share you own. You might notice when you put your tax return in that your dividend was only $100, but your taxable income has actually increased by $130. Now let's tax Dave properly. His taxable income is $20. This passes the wage test. His tax due is $7. This passes the wage test. If Dave deducts his $6 franking credits from his tax bill, he owes another $1, and his final tax paid is $7. So this all passes the wage test and seems fair. Now Dave's personal tax rate won't always be 35%. If it goes up, he pays more tax to top up the difference between the tax already paid. If it goes down, he gets that back as a credit and it's deducted from his tax bill. So that's where we are now. Now, if all of this makes sense so far and it looks fair, you may or may not be surprised to learn that you just saw Dave receive a franking credit refund from the tax office. Remember when the company which Dave owns originally paid tax? This is now gone. At this point, some will say he now hasn't been taxed because his taxable income is low enough that he pays no tax at all. However, this is not entirely true, as the dividend and the franking credit still form part of his taxable income. To prove this, let's assume Dave's Donuts made a more realistic $25,700 profit, and he distributes it all back to himself as a franked dividend. Dave receives only $17,990, below the individual tax-free threshold. He also receives $7,710 in franking credits. Any other individual would be below the tax-free threshold and pay no tax. But that doesn't pass the wage test for Dave. Dave pays tax on the full $25,700 because the franking credits are a part of his income and he is responsible for them. He receives some back, but some are still retained at the tax office to represent the amount of tax paid if he had been paid a wage. The tax office now has the same amount of money as if he had $25,700 in his pocket. That is also exactly what his business, which he owns, made in profit. So a possible question is, how does all of this relate to retirees? And the answer is it doesn't. The legislation applies to everyone in Australia. I could go into more detail about how a completely different rule gives retirees a 0% effective tax rate, which could be perceived as a problem because franking credit refunds are then very large numbers. When any franking credit refund is sent out, none of it comes from funds other than those already paid by the company or portion of the company owned by the shareholder. The company cannot distribute more franking credits than tax paid.